5 years ago, the quiet town of Sioux Falls, South Dakota, was rocked by a financial crime that would make history as the largest in the state's history. This is the story at how a small-town investment firm, Peregrine Financial Group, and its CEO, Russell Wassendorf Sr., orchestrated a massive fraud scheme that would leave thousands of investors across the country reeling. The year was 2012, and the financial world was still recovering from the aftermath of the 2008 recession. But in Sioux Falls, things seemed to be going well for Peregrine Financial Group. The firm had built a reputation as a trusted investment partner with over $1 billion in assets and more than 24,000 customers nationwide. But behind the scenes, Wassendorf was cooking up a scheme that would make him millions while putting his investors' hard-earned money at risk. For nearly 2 decades, he had been falsifying bank statements, hiding the fact that Peregrine's accounts were severely underfunded. By the time the fraud was uncovered, it was estimated that Wassendorf had stolen over $100 million from his customers. The fallout was swift and severe. The Commodity Futures Trading Commission charged Wassendorf with multiple counts of fraud, and he was eventually sentenced to 50 years in prison. Peregrine Financial Group filed for bankruptcy, leaving its investors to scramble to recover their losses. But the impact of this financial crime went far beyond Sioux Falls and the investors who lost their savings. It exposed a larger problem within the financial industry, one of lax regulations, lack of transparency, and an overemphasis on profit at the expense of ethics. In this documentary, we will follow the money trail that led to Peregrine Financial Group's downfall, uncovering the systemic failures that allowed this massive fraud to go undetected for so long. We will talk to experts, investors, and whistleblowers who saw firsthand the devastating impact of Wassendorf's actions. And we will explore what this case tells us about the state of financial regulation in America today, and what needs to change to prevent similar crimes from happening in the future. The Money Trail continues to unravel the biggest financial crime in South Dakota's history, a story that left thousands of victims, and one man at the center of it all, Terry Wolf Wassendorf Sr., former CEO of PFG Best, a now defunct futures brokerage firm. Wassendorf's elaborate scheme began to unravel on July 9, 2012, when he attempted suicide in the company's parking lot. Hidden in his car was a note confessing to a $200 million fraud, a staggering sum that left investors reeling and questioning how such a massive crime could go undetected for so long. At the heart of this scheme was Wassendorf's carefully crafted web of deceit, which revolved around creating fake bank statements to convince regulators, investors, and even his own employees that PFG Best had more than enough capital to cover its obligations. Key players in this scandal include Russell Ruffino, who took over as CEO after Wassendorf's suicide attempt, Gerald Durick, the company's CFO, and a network of overseas banks and financial institutions that helped facilitate the fraudulent transactions. Russell Ruffino, who had been with PFG Best for just 6 months before taking over as CEO, was tasked with steering the troubled firm through its darkest days. He quickly discovered the extent of Wassendorf's crimes and became a crucial witness in the subsequent investigation. Meanwhile, Gerald Durick, who served as CFO during much of the fraud, has been accused of turning a blind eye to the red flags that should have alerted him to the scheme. He has denied any wrongdoing and maintains that he was unaware of Wassendorf's actions. As we delve deeper into the story, it becomes clear that the failures of regulators, auditors, and watchdogs allowed Wassendorf's fraud to go undetected for so long. The question remains, how can we prevent similar crimes from happening in the future? Join us as we continue to follow the money trail and explore the critical reforms needed to protect investors and restore trust in our financial system. The intricate web of deceit woven by convicted fraudster Scott W. Wassendorf is a chilling reminder of how greed and manipulation can bring even the most respected financial institutions to their knees. Over 2 decades, Wassendorf managed to siphon off approximately $130 million from his Iowa-based commodities brokerage firm, PFG Best. His methods were as ingenious as they were ruthless. Wassendorf forged bank documents and signatures, fabricated financial statements, and even created a phony bank building complete with exterior signs to convince auditors of the firm's solvency. His elaborate schemes allowed him to misappropriate funds from customer accounts, using them to fund his luxurious lifestyle and hide massive losses incurred by poor investment decisions. The extent of financial loss is staggering. Over $130 million vanished into thin air, affecting thousands of investors who had entrusted their savings with PFG Best. The National Futures Association stepped in to liquidate the firm and repay clients as much as possible, but many were still left grappling with significant financial setbacks. What's particularly concerning is that this fraudulent activity went undetected for so long. Regulators, auditors, and watchdogs failed to notice warning signs or thoroughly investigate suspicious activities. This highlights a critical issue within our financial system, the need for stricter regulations, more rigorous oversight, and enhanced transparency. As we follow the money trail, it becomes evident that the responsibility lies not only with individual actors like Wassendorf, but also with institutions that enable such crimes through negligence or incompetence. Preventing similar occurrences in the future requires a comprehensive overhaul of our regulatory framework, ensuring greater accountability and stronger protections for consumers. In the next segment, we'll examine specific reforms needed to restore trust in our financial system, drawing lessons from this colossal fraud case. We must understand how these crimes happen and what can be done to stop them. fostering an environment where investors feel secure and confident about their financial decisions. As we delve deeper into this financial crime that shook South Dakota, it's crucial to examine the regulatory failures which allowed such fraudulent activities to flourish. At the heart of this scandal is a man named Joe Miedema, former CEO of Midcontinent Communications, now known as Midco. In 2015, Miedema and his associates were involved in a Ponzi scheme that defrauded investors out of over $4 million. The South Dakota Securities Department was responsible for regulating these activities but failed miserably. Despite numerous red flags, including unsolicited investment offers, unusually high returns, and lack of transparency about where the money was being invested, no action was taken until it was too late. The investigation revealed that Miedema used investor funds to finance his luxurious lifestyle, including buying a private jet and funding his daughter's wedding. Yet, even after these revelations, the Securities Department did not face any consequences for their regulatory lapses. This raises serious questions about the effectiveness of our current regulatory framework. How can we ensure greater accountability and stronger protections for consumers when those tasked with enforcing regulations are not held responsible for their failures? One potential solution could be stricter penalties for regulatory bodies that fail to act on clear evidence of fraud. This could include fines, suspensions, or even termination of staff members who repeatedly fail to enforce regulations adequately. Another possible reform is increasing transparency and communication between regulatory bodies and the public. By providing regular updates on ongoing investigations and highlighting common tactics used by scammers, regulators can help educate consumers and empower them to make informed decisions. In addition, implementing technology-based solutions such as artificial intelligence and machine learning algorithms could help regulators detect patterns of fraudulent behavior earlier and more accurately. These reforms are not just about punishing wrongdoers, they're about creating a financial system where consumers can trust that their investments are safe and being managed responsibly. It's time for South Dakota, and indeed all states, to take a hard look at their regulatory frameworks and implement changes necessary to prevent future financial crimes. In the next segment, we will explore specific reforms needed to restore trust in our financial system, drawing lessons from this colossal fraud case. The fallout from South Dakota's biggest financial crime was as devastating as it was far-reaching. At the heart of this catastrophe were thousands of victims, average, hardworking Americans who had trusted their life savings to a man named Lee Lacy. Lacy, a seemingly respectable businessman, ran a company called Tier 1 Financial. He promised his clients stability and returns on their investments, but instead he orchestrated a massive Ponzi scheme that defrauded thousands of investors out of over $3 billion. When the scheme collapsed in 2010, it left behind a trail of shattered lives and broken dreams. One such victim was Linda, a retired schoolteacher from Sioux Falls. She had invested her entire pension fund with Tier 1, believing in Lacy's reassuring words and the glossy brochures that promised safe and secure investments. When the truth came to light, she found herself penniless, forced to sell her home and live off meager Social Security checks. But the impact didn't stop with individual victims like Linda. It rippled through the wider community too. Local businesses that had invested their operating capital in Tier 1 were left scrambling for survival. Some managed to stay afloat, but many others succumbed to the financial strain, leading to job losses and further economic hardship. The broader economy also took a hit. The Securities and Exchange Commission reported that the fraud had caused significant volatility in regional markets, affecting not just South Dakota, but neighboring states as well. Confidence in the financial system plummeted, causing many potential investors to shy away from the market altogether. In short, Lacy's crime didn't just affect those who lost money directly, it undermined the very fabric of trust and stability upon which our economy depends. As we delve deeper into this story, we'll see how such crimes can be prevented in the future, ensuring that no other community has to endure what Sioux Falls did a decade ago. After Lacy's Ponzi scheme collapsed, the legal proceedings began. In October 2011, Lacy pleaded guilty to 15 counts of wire fraud and 1 count of conspiracy to commit wire fraud. Each wire fraud charge carried a maximum sentence of 20 years in prison, while the conspiracy charge carried a 5-year term. However, these sentences could run concurrently, meaning Lacy might serve them simultaneously rather than one after another. The plea deal also required Lacy to forfeit over $83 million in assets, including multiple properties, luxury vehicles, and substantial sums held in various bank accounts. This forfeiture represented a significant portion of the funds he had misappropriated from his investors. In April 2013, Lacy was sentenced to 50 years in federal prison, the maximum allowed under his plea agreement. The judge cited not only the scale of Lacy's fraud, but also its impact on individuals and communities throughout South Dakota. But what about those who helped Lacy carry out his scheme? Scott Wick, Lacy's right-hand man, was sentenced to 10 years in prison for his role in the scam. He had assisted Lacy in luring investors, fabricating false financial statements, and distributing fraudulent account information. Other accomplices received lesser sentences. Diane Six, a former employee of Lacey's investment firm, was sentenced to 3 years probation for lying to investigators about her knowledge of the Ponzi scheme. Jeffrey Knightsky, another ex-employee, received 6 months home confinement and 5 years probation after providing substantial assistance to prosecutors during their investigation. These legal outcomes served as a stark reminder of the severe consequences faced by those who commit financial crimes. Yet, they also underscored the importance of vigilance and due diligence in protecting oneself from investment fraud. As we move forward, understanding how such schemes operate and learning to recognize the warning signs can help prevent similar occurrences and safeguard our financial future. The collapse of the Ponzi scheme orchestrated by Russell Erxleben in 1999 remains the largest financial crime in South Dakota's history, having swindled over $53 million from unsuspecting investors. This case serves as a stark reminder of the devastating consequences that investment fraud can have on people's lives and livelihoods. But what lessons have been learned, and how can we prevent similar occurrences in the future? First and foremost, it is crucial to understand how these schemes operate. Erxleben lured investors with promises of lucrative returns from the sale of rare, high-performance European sports cars, an area where he claimed expertise. However, instead of investing the funds as promised, he used them to fund his extravagant lifestyle and pay off earlier investors. This is a classic example of an affinity fraud, where con artists exploit their relationships with a specific group of people to gain their trust and access their money. To protect ourselves from falling victim to such schemes, we must remain vigilant and educate ourselves on the warning signs of investment fraud. One key red flag is the promise of unusually high or guaranteed returns. If an opportunity seems too good to be true, it probably is. Additionally, investors should exercise due diligence by verifying the legitimacy of any investment, checking the background of those soliciting funds, and seeking advice from a trusted financial advisor. The Erxleben case also highlights the importance of regulatory oversight in detecting and preventing financial crimes. While state and federal agencies ultimately brought charges against Erxleben, it took years for his scheme to unravel, time during which countless investors suffered significant losses. Strengthened regulations and increased resources for enforcement can help ensure that fraudsters are caught earlier, reducing the harm they inflict on innocent people. In conclusion, the largest financial crime in South Dakota's history should serve as a wake-up call for all of us to be vigilant and informed when it comes to our investments. By understanding how these schemes operate, recognizing the warning signs, and advocating for stronger regulations, we can safeguard not only our own financial futures but also those of our communities. As the saying goes, an ounce of prevention is worth a pound of cure, and in the world of investment fraud, this has never been more true. In the end, the biggest financial crime in South Dakota history served as a wake-up call for investors and regulators alike. The story of this massive Ponzi scheme, orchestrated by Scott W. Tucker through his payday lending businesses, revealed the stark reality of investment fraud and its devastating consequences. With illicit gains amounting to over $3.5 billion, Tucker's elaborate web of deceit shattered countless lives and left many questioning the integrity of our financial systems. The fallout from this crime extended far beyond South Dakota, as investigators uncovered similar schemes operating across state lines. This case exposed critical gaps in regulatory oversight and enforcement, prompting calls for increased vigilance and collaboration among authorities at both federal and state levels. Yet, it is essential to remember that investment fraud is not an isolated incident, confined to headlines or history books. It remains a pervasive threat in today's financial landscape, preying on unsuspecting investors who may lack the necessary knowledge or resources to protect themselves. The Tucker case serves as a cautionary tale, urging us all to be vigilant and informed when it comes to our investments. By understanding how these schemes operate, recognizing warning signs, and advocating for stronger regulations, we can safeguard not only our own financial futures but also those of our communities. As the saying goes, an ounce of prevention is worth a pound of cure, and in the world of investment fraud, this has never been more true. As we reflect on the legacy of South Dakota's most significant financial crime, let us not forget that lasting change begins with individual awareness and action. In an era where information is abundant yet often misused, it falls upon each one of us to be vigilant stewards of our own financial well-being. By doing so, we honor the victims of fraudulent schemes like Tucker's and contribute to a more secure financial future for all. In conclusion, the biggest financial crime in South Dakota history will forever serve as a stark reminder of the vulnerabilities that exist within our financial systems. But from tragedy can come transformation. If we choose to learn from the past and apply those lessons to build a brighter, safer financial future for generations to come.